As early as 1926, there were signs that the boom was under threat. This was seen in the collapse of land prices in Florida. There were many economic issues leading up to the crash, and together they caused the Wall Street crash. Eventually, there were too many goods being made and not enough people to buy them. Farms had also produced too much food in the 1920s, so prices for their produce became gradually lower. There were too many small banks. These banks did not have enough funds to cope with the sudden rush to take out savings, which happened in the autumn of 1929. Too much speculation on the stock market was also a major cause. The middle class had a lot to lose, and they spent a lot on what amounted to pieces of paper. The Wall Street crash of October 1929 was a massive psychological blow. America had lent huge sums of money to European countries. When the stock market collapsed, however, they suddenly recalled these loans. This had a devastating impact on the European economy. The collapse of European banks caused a world financial crisis.
Course. 5th of March 1929, the last day of Calvin Coolidge as president before Herbert Hoover takes over. Coolidge insisted that the shares are cheap at current prices. This was the first vision of the crash to come. 26th of March, the public begins to fear that the Federal Reserve will clamp down on speculation, where people predict the economy. This causes panic trading, and record volumes are traded. This slightly boosts the economy. 9th of August, following months of silence, the Federal Reserve raises interest rates. A laissez-faire policy, where the government does not interfere in commercial affairs, means that the value of shares fall for just one day, and then increase shortly after. 3rd of September. The all-time high of the Dow Jones Index, the average share price in the US, occurs at 381 points. This level is not hit again until November 1954, over 25 years later. 15th of October. Just before the crash, the well-known guru, Professor Irving Fisher of Yale, says that the stock prices have reached what looks like a permanently high plateau. 24th of October. Panic selling is caused by nervousness over public finances. This drives the prices down so more people sell, which causes positive feedback. The mass selling continues. 30th of October. Share prices rise slightly after John D. Rockefeller, a very well-known US tycoon, says that the economy is sound and that he is buying shares. 13th of November. His statement is followed by a small increase in value, and then another drop down to 200 points, where the market reaches its bottom. A slow recovery process begins, but conditions stay bad until World War II.
Consequences. The Wall Street crash caused a range of long and short-term consequences for many people. Perhaps the most important consequence was the devastating effect the Wall Street crash had on people's life savings. Immediately after the crash, many banks and businesses were forced to close, so people lost all the money they had invested. This devastated people's fortunes and the public opinion towards banks. Things only got worse in the years to follow, during the Depression, which was without doubt linked to the crash. The Dow Jones Index finally began to recover in 1932. Previously, businessmen had loved trading in the stock exchange, as a lot of money was to be gained from it. Many years after the crash, however, people avoided trading shares because they now knew the potential consequences of it. The market did not reach the price levels of September 1929 until late in 1954. Also, closed businesses and companies meant that many people lost their jobs or had their wages lowered. This meant that the number of unemployed people skyrocketed. The same was also for farmers, who were unable to pay loans for their land and were evicted and forced to look for other work. The crash in the US also had impacts on other countries, especially Europe, because they were forced to pay off the debts they owed the US from World War I. This in turn had an impact on overseas trading, which brought other economies down. Overall, the Wall Street crash and the Great Depression that followed meant poorer living standards and a tougher life for everyone who was affected. The crash remains a byword for financial trauma to this day.